In the space of basic stocks, a trader has only a pair of actions to choose from, buying or selling. The only trade-off a shareholder has about being in a position is whether or not there's profit to be made. Options, on the other hand, open a wide range of choices that must be considered when making a trade. Once you enter a trade, a lot of things can happen that will influence your near and far-term decision, far beyond the question of just the current stock price. As you may have noticed, things tend to happen in pairs with options. There are puts and calls, you can buy or sell, there's a strike price and a spot price. But the very first decision to make is whether or not you're going to get into a position in the first place. Regardless if you are on the buying or selling side of a contract, when you initiate the agreement for the first time, you are opening the position. Before, you had nothing. You managed no calls or puts. Afterwards, in one fashion or another, you are in control of some combination of calls and puts. After some time of being in the position, you may choose to exit the position. This may occur at a profit or loss, and if you followed a sound and well-tested trading strategy, then hopefully you will exit with a profit. This is considered closing the position. At this point, you receive no benefit from the position any longer because you are no longer part of the contract. You also no longer share any of the risk. You have realized your profit or loss at the time of the close, and it will become noted in your account balance. This is a fairly intuitive concept if you're on the buyer's side of a trade. You buy a position to open it, and you sell it to close it. You first spend money, say $100, to open the position, and then ideally you sell it for a higher value, say $125, to close it for a $25 profit. However, it's less intuitive on the seller's side. To open a position that you are selling, someone pays you a premium, that is, you receive a credit to your account for opening. When you close the position, you'll receive a debit. This means that in order to profit, you need to close the position for less money than you received credit for. If you received $100, you'd like to close it for $75 in order to make $25 in profit. If you closed it for a debit of $125, you'd instead take a loss of $25. When you open or close a position, it will either cost you money or lose you money. If the net of what you opened the position for and what you closed it for is positive, you made a profit. Congratulations. Otherwise, you took a loss. The interesting thing about options is that you can be a seller, meaning you can earn money at the time of open and your account balance will increase. This is called taking on a credit. In order to close a position as an option writer, you need to take on a debit, meaning you need to pay back part of the money you earned when you originally sold the position. Of course, this is all reversed as a buyer. When you open a position, your account drops in value as you are being debited. If all has gone well, when you finally close the position, you earn a credit, and hopefully it is far larger than the debit you spent getting into the position. Why are we concerned about these terms that are typically associated with bank accounts, profit and loss sheets, and budgets? Because if you are an options trader, you will be dealing with all of these elements of finance. You will need to know what your bank account values are and how much they change with each transaction. You will need to know your profit and loss statements so you can see how your portfolio is doing over time. And as you deposit and withdraw money from your options trading account, you need to know the impact on any budget you have. In the more specific world of options trading, however, credit and debit take on more importance when you buy or sell combinations of calls and puts. You may sell a call at one strike price and buy another at a different strike price, for example. Whether or not you are considered a seller or buyer depends on if you end up with a net credit or a net debit respectively. For more complex positions, it becomes critical to track your net credit and debit so that you are always aware of your current profit and loss and can take future actions appropriately, such as when you need to make adjustments to a position. In the pure essence of options trading, there is only an open position or a closed position. You can't technically move a position around. Doing so requires you to close it from where it is and then reopen it at another strike price, expiration date, or both. In any case, when you close with either a debit or credit. However, depending on your strategy, you can compensate for that by reopening the position in a more favorable light. Doing so is called rolling or adjusting. Definitions might vary slightly between traders and their respective communities, but I like to look at adjustments as trades that happen within a given expiration period. If I close a put at the 100 strike and reopen the put at the 110 strike, I've made an adjustment. This can happen with more complex option structures as well, where you simultaneously close all the components, the various legs, before reopening the same structure adjusted for strike price. Likewise, you can also move a position through time, moving from one expiration period to another. This is called rolling. If you close a position in June at the $100 strike and reopen the same position at the $100 strike but in July, you have rolled the position. If you happen to change the strike to $90, you will both have rolled and adjusted for the position, though typically we just use one phrase, either rolling or adjusting. What is important is to recognize that you always have choices of what you can do with an open position. You can close it, ideally for a profit, you can move it around within a given expiration period, and you can also move it between expiration periods. One thing about houses is that no one would ever try to sell a house they don't own. Nor would someone try to buy a house from someone who doesn't at least hold the deed and the keys to the house. At best, it's stupid, at worst, it's fraud. However, in stock options trading, a trader can indeed trade a position where they do not technically own the underlying stock position, and that's not in any way, shape, or form fraudulent. In fact, it's expected and is often of great utility in more sophisticated trading scenarios. Someone who sells a stock they do not own is said to be short. They are allowed to be short because their broker will loan them the collateral to complete the transaction. Obviously, this can't happen with houses. No banker is going to loan you a house so you can sell it to someone else. Bankers loan money for houses, not the actual houses. The digital world of options trading and finance allow for a lot more flexibility. If one can be short, the opposite of that is to be long, in which case the trader possesses the collateral. If you own your home, you are in a long position because you can take advantage of the appreciation that happens and you don't owe anyone else a house. Though you owe the bank a mortgage, but that's different from the house itself. Likewise, as the terms long and short apply to stocks, so do they apply to options. When you purchase an option, you are said to be long the position. This is a way of saying that you have opened a call or put where you own the option. The person on the other side of the contract, the seller or writer, is said to be short the position. Since you can be long or short options, when assignment occurs, you can likewise end up being short or long stocks. If the options writer happens to already own the stocks and are forced to sell upon assignment, the appropriate number of those stocks will be transferred to the new owner. The original holder is simply out of that position and thus no longer long, unless they have some more stock remaining, of course. If the trader does not own the stocks, then the trader is assigned a short stock position. As noted earlier, their broker will essentially front them the capital to hold a negative sum of shares, and this is reflected in their balance. The trading platform will actually show, for example, negative 200 shares of Microsoft, meaning the trader owes the broker 200 shares of the stock. On the other side, if the trader is forced to buy the shares, then they must pay for those shares out of their own account, which is appropriately diminished, and the trader will be long their position. When it comes to options, being short or long a position really gives very little indication to the strategy that the trader may be employing. Used in conjunction with some other concepts, you'll start to be able to infer many things about a position once you hear if it is long or short, including whether or not the option holder is directionally inclined. That is, the option holder has made a supposition that the underlying stock will move in a particular direction, or not. Being bullish or bearish means you have an opinion about the direction of the market. An open position is bearish if the holder of the position would profit from a down move in the market. If the position would profit from an up move in the market, then the position is considered bullish. If the position would not benefit from either an up or down move, then it is considered neutral. There are various degrees of movement as well. One can be slightly bearish or slightly bullish, or neutral to bullish, for example. In this article, what we've covered are pairs of words that will help us distinguish the nature of our options positions. We open a position to indicate we become active in the market. We close the position to indicate when we are exiting. We take on a credit or debit when opening, depending on whether or not we're selling or buying the option contract respectively. Likewise, we receive the opposite when closing a position, thus realizing a profit or loss. We say a position is bullish if an up move by the underlying helps the profitability of the position. Vice versa, we say it is bearish for down moves that are profitable. Otherwise, the position is neutral. Open, close, short, long, bullish, bearish, credit, debit are all part of the common vernacular for options trading. Knowing them well is essential to furthering your options trading education. Short and long in particular become more important as the notion of having the option to exercise a contract or being on the other side and obligated to fill that contract has deep implications on how the myriad of options trading strategies work. Thanks a lot for taking the time to listen.